Look, we just had the latest, David Einhorn, coming out saying, I'm worried about the sheer scale of AI infrastructure investment at the moment and that billions is going to be lost in terms of capital. What are you thinking of these warnings around a bubble?
Yeah. It's clear we're seeing explosive demand growth that we've really never seen before. That doesn't mean it's not real, but it does mean that we should continue to really look at these valuations and perform these sanity checks. And what gives me some confidence when I'm performing my sanity check is that this infrastructure wave, as significant as it is powered by real demand growth that is already showing up in the numbers. It's funded by real cash flows. And even after all of this enormous spending, the 4 major hyperscalers, they're still free cash flow positive. And so there's a lot of demand and still the supply constraint on infrastructure is there. So there's no like house of cards underneath this AI infrastructure wave, I'd say. But still, I think the AI theme it's a long-term one. DeepSeek was one upset that we had earlier this year. There will surely be others. And right now we're in this kind of period of digestion. But I think we're just waiting for that next piece of like bullish commentary and data. And then we're going to appreciate the fundamentals once more.
Nvidia's dominance in AI chips and optimistic outlook for data centers drove the pre-market rise. The majority of analysts are optimistic, pointing to the innovation edge, although they warn against unrealistic expectations. Investors are placing bets on sustained growth momentum and possible profit beats. In Monday's pre-market trade, Nvidia's shares soared, reviving investor excitement. The company has been thriving because of its advanced data center and artificial intelligence technologies, but a day's increase feels like a new round of market confidence. The next earnings report is clearly a source of excitement, but the larger picture, Nvidia's capacity to continue producing in a cutthroat and rapidly evolving market, is equally important. Traders are already placing bets on positive news even if the figures are not yet available. What is driving the rise in Nvidia's stock price? The primary driver of Nvidia's stock increase is rising confidence in its leadership in AI and product pipeline. The company's growing presence in AI computing has caught the attention of investors, as its GPUs are now essential for training big language models and other machine learning applications. Newly revealed enhancements targeted at data center applications and AI workloads gave traders confidence that Nvidia is preparing to take advantage of a rapidly expanding industry. In the meantime, next-generation game releases and the introduction of its newest graphics cards have supported the constant demand from gamers. Nvidia's optimistic guidance forecast is another element contributing to the stock's rise. The data center segment has been the biggest growth driver in recent quarters, and the business has projected good revenue growth for this segment. Furthermore, long-term structural trends like cloud adoption and digital transformation are helping the semiconductor sector by raising demand for high-performance devices. Because of its strategic location at this crossroads, Nvidia has benefited from several growth drivers coming together at once, luring investors to invest before the official announcement of quarterly data. What do analysts say? While some are raising red flags, most Wall Street analysts are cheering from the sidelines. The prevailing opinion? Being the industry leader in AI chips gives Nvidia a significant competitive edge. According to analysts, the company's ability to innovate keeps it one step ahead of its competitors, particularly when it comes to products that cater to both gamers and large data centers. There's a catch, though. Any error in orders or growth projections might frighten investors, as Nvidia's stock price now represents a large portion of future growth. Nevertheless, the majority of experts continue to recommend Nvidia as a buy. Expected earnings beating and good product rollouts have many seeing more potential. With the pre-market rise capturing the market's wager on Nvidia's bright future, the optimism appears to be warranted for the time being. Nvidia is influencing the entire ocean, not simply riding a wave, and investors are eager to ride the wave first. Data center sales reached $41.1 billion, revenue increased by more than 50% to $46.7 billion, gross margins exceeded 72%, and the board authorized a new $60 billion repurchase. Spending on capital equipment has surged to levels reminiscent of previous tech booms, casting doubt on the ability of AI investments to yield the anticipated returns. Beyond the current AI craze, Nvidia's leadership in robotics, industrial automation, and quantum computing may propel the company's expansion over the ensuing 10 years. The artificial intelligence, AI boom revolves around Nvidia. but investors disagree about whether this is the beginning or the end of a bubble. Growing anxiety is reflected in the stock's 2% decline in the last 30 days after rising 56% over the previous 6 months. At first glance, the figures are clear. Revenue reached $46.7 billion in the second quarter of fiscal 2026, and gross margins exceeded 72%. However, red flags are emerging. Businesses doubting AI's ROI, rivals keen to challenge Nvidia's hegemony, and capital expenditures at bubble-like levels. Most likely, the truth is somewhere between ecstasy and collapse. The foundation of AI infrastructure is still Nvidia, but it might already be motivated by quick cash. The crucial query for October is whether the stock is still a good investment, or if the market has already reached the ideal price. In its most recent quarter, Nvidia not only met but exceeded expectations. The company's overall revenue nearly doubled from only 2 years ago as data center sales climbed to $41.1 billion. With a $60 billion buyback secured in place and $24.3 billion returned in the first half of fiscal 2026, shareholders received a substantial payoff. Those are a statement of confidence in a cash machine that isn't slowing down, not defensive tactics. Additionally, the approach extends beyond GPUs. Nvidia's intention to influence whole computing stacks, rather than just dominate acceleration, is indicated by its recent $5 billion investment in Intel. While Rubin and Feynman, the next-generation processors already in the works, keep the roadmap filled, the Blackwell architecture is rapidly ramping up on the product front. Lastly, there are the clients. Without Nvidia Silicon, Alphabet, Amazon, and Microsoft cannot develop their AI goals. Pricing power comes when each hyperscaler is dependent on your hardware. The evidence is the 72% gross margins, which are a fact rather than an ideal. When capital investment reaches its current excesses, history advises caution. Today, AI takes the role of the internet as the narrative fuel, but the investment cycle still seems quite similar to 1999. Without conclusive proof of end-user ROI, this circular validation leads to risky echo chamber economics. Each player's investment supports the next. Microsoft notes the demand for AI as seen by its investment in OpenAI, which purchases Nvidia chips. Businesses experimenting with AI, meanwhile, claim varying degrees of success. Costs go over budget, productivity benefits are elusive, and many trial initiatives fail to scale. Customers won't continue purchasing $40,000 GPUs eternally if they are unable to profit from AI. The level of competition is higher than investors realize. With the MI300 processors, advanced micro devices gained headway. Custom silicon for hyperscalers is dominated by Broadcom. In-house chip development is accelerated by Amazon, Alphabet, and Meta platforms. In this sense, even Intel's Gaudi chips exhibit promise. Although Nvidia's moat is still strong, its 90% market share can only go down from here. Nvidia's larger play is missed by the bear argument, which frequently ends at today's AI surge. This corporation has established hedges that will sustain its supremacy into the next computing era, so it is not a one-trick pony experiencing a brief rise. Consider research on quantum computing. Long before the hardware is available, the top labs in the world use Nvidia's CUDA platform and DGX systems to simulate quantum algorithms. Nvidia's edge computing solutions are already used in robotics for everything from autonomous cars to warehouse automation. Additionally, the workloads in industrial automation, whether in material science, medicine development, or climate modeling, require accelerated computing, which Nvidia is the only company that can provide at scale. Thus, Nvidia won't be left in a bind when the demand for AI training ultimately declines. Workloads for inference alone might compete with current training revenue, and scientific computing or robotics could provide completely new growth avenues. The market may be perfectly priced at $4.3 trillion, but the company's portfolio suggests that there are still a number of acts to come. The October decision. As October approaches, there are no simple solutions in Nvidia's stock. Bulls see a monopoly on data center computation, 72% margins, and an inevitable deployment of AI. Bears cite bubble-level prices in the AI space, a poor return on AI investments thus far, and competitors keen to challenge Nvidia's hegemony. There are good arguments on both sides. After a 6-month run of 56%, traders view the setup as hazardous because even a slight shortfall on Blackwell shipments or hyperscaler demand may cause a 20% to 30% reversal. With exposure to AI, quantum, robotics, and industrial automation, Nvidia continues to be the best bet for long-term investors looking to speculate on the direction of computing. The leading GPU manufacturer keeps funding AI-related businesses. Retail investors should look into these companies just because of its involvement with them. You've undoubtedly heard that Nvidia, the world's largest business by market capitalization and a leader in AI chips, recently revealed plans to acquire a $5 billion investment in rival Intel. Additionally, it intends to invest $100 billion over a number of years in OpenAI, the company that developed ChatGPT. Don't worry if that seems a little crazy. Many publicly traded corporations own stock in other companies. Furthermore, Nvidia already owns sizable shares in 6 other tech firms: AI cloud computing infrastructure company CoreWeave. ARM Holdings is a British company that specializes in software and semiconductor design. Applied Digital is a data center manufacturer and operator. Nebius Group is a Dutch business that offers platforms and infrastructure for AI. AI is being used by clinical stage firm Recursion Pharmaceuticals to find new, potent medications. WeRide is an autonomous car firm based in China. Let's examine these investments in more detail. About 24.3 million shares of CoreWeave are owned by Nvidia. That shareholding is valued at almost $3 billion at the current share price. Based in Livingston, New Jersey, CoreWeave buys a lot of Nvidia GPUs and installs them in servers before renting out the servers to its clients. Nvidia and CoreWeave announced a new deal this month whereby the chip giant will buy any extra CoreWeave cloud capacity that isn't licensed to other clients. To date, CoreWeave's stock has increased 247%. ARM Holdings. For a total estimated value of $152 million, Nvidia owns roughly 1.1 million shares of the British chip and software design firm. Indeed, it made a bid to purchase ARM in 2020, but regulators blocked the deal. The stock has increased 147% over the last 5 years and 10% this year. Given that Intel and ARM share significant similarities, the recent Nvidia-Intel merger could be seen as somewhat of a setback for ARM. Applied Digital. Nvidia has around $169 million worth of ownership in 7.7 million shares of the data center operator. Naturally, Applied Digital servers are equipped with Nvidia CPUs. So far this year, the stock has increased 187%. Nebius Group. Nvidia has over 1.2 million shares in the company, which is valued at $134 million. In 2025, the stock price has increased by over 300%. Nvidia purchased a $50 million interest in Recursion Pharmaceuticals in July 2023, but the biotech's share price has since dropped, making Recursion one of the chip giant's unusual losers. With a 31% year-to-date decline, the share is now worth roughly $36 million. Biotech businesses are very risky ventures, especially those that are still in the clinical stage. WeRide. Currently valued at over $19 million, Nvidia owns roughly 1.7 million shares of the robotaxi startup. After Nvidia revealed its ownership stake in WeRide, the company's stock price surged in February, but it has since dropped. This year, they have now dropped by almost 20%. Data centers, AI infrastructure and server providers, and chip designers are Nvidia's primary AI investments, and they seem to be performing remarkably well. Additionally, since the news broke on September 18th that Nvidia was investing in the established semiconductor manufacturer, Intel's stock price has increased by 33%. Nvidia, on the other hand, has not yet seen success from its more ambitious and typically smaller investments in biotech and autonomous vehicles. Paper losses of that magnitude are obviously not even rounding errors on your balance sheet when your market capitalization is $4.3 trillion. They might also turn out to be lucrative investments in the long run. All of Nvidia's equities are worth investigating, though, simply because the company has invested in these businesses and thus likely has a stake in their success. Investor interest in Nvidia shares has grown recently, as recent trading subtly changes the conversation about the company's potential future direction. The decision appears to be the result of a market attempt to adjust expectations for a business that is closely associated with major technological advances, including artificial intelligence and data processing, rather than being spurred by a noteworthy development or abrupt change. For investors, this type of activity brings up an important question. Is the market simply taking a moment to reevaluate, or are we witnessing the first indications of a shifting outlook? Taking a broader view, Nvidia's performance over the last 12 months has been outstanding, with a 47% return during that period. Shorter-term findings indicate times of volatility, with the last month showing a slight increase and the last 3 months showing greater momentum. Although this implies that momentum is still present, it follows a run of remarkable long-term gains, indicating that investors are still feeling both cautious and optimistic about the company. The true question following this year's significant increase is whether Nvidia is currently undervalued, or if the market has already factored in all of the company's potential growth. The most popular narrative, according to Kiwi Invest, rates Nvidia as somewhat overpriced. This opinion is dependent on Nvidia's sustained supremacy in the data center and AI areas, as well as aggressive revenue growth forecasts. $400 billion in revenue per year, assuming Nvidia maintains its leadership in AI software stack and GPU design. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.